towards what's going on with the stock market anyway, and talk about what happened with the debate last night and CPI this morning and how that's impacting the markets, and see what we can do with that. But before we get into that, let's do the disclosures. Options involve substantial risk and are not suitable for all investors. Tradespoon and the presenter of this video, Keith Harwood, are not investment advisors, not registered with the SEC, not registered with FINRA. The information in this presentation is solely for educational purposes and should not be considered trading advice. All right. Myself or the team at Tradespoon may have a financial interest in the securities presented and the trade picks, so please keep that in mind as you evaluate these ideas for yourself. If you do have questions about your personal account, please consult with your registered financial advisor. Do something a little different this morning here because it is September 11th. Why don't we do a brief moment of silence here, and then we'll get started on the presentation. You for the content for the day. Before I get into trading psychology, I normally do afternoon closing bell stuff, so some of you may not always attend that. And so for those that are not familiar with me, I am Keith Harwood. I am the president of Option Hotline, and I do a lot of work similar to what Vlad's got going here with Tradespoon and Yale Tunnel. We're working on a new trading concept together. So I've been working with Vlad on doing more of the closing bell and now morning bell conversations here with you guys, help you walk through the trading education side of things. I started on the CBOE floor in 2005 as a market maker in the options pits. Traded through the subprime crisis, moved off floor, switched from market making to prop trading, and basically traded everything. I traded as a market maker in European fixed income, the 2-year, 5-year, 10-year, the boom, bubble, and shots. I traded gold and silver as a market maker, the options on gold and silver. And then after I got my MBA from the University of Chicago, I switched to working for a hedge fund. Did all of their option strategies, worked with them. They gave me the thesis, the directional bias, talked through me with the technical trades, and I worked on the options trade that works best given the options market setup and their price targets. So generally speaking, I've kind of done a little bit of everything. Started into the educational side here 7 years ago. So been doing this now since 2017, 7.5 years, I guess now. And it's been a lot of fun working with people. And, just like Vlad, my motto has always been trade smarter. And I think that that's the right approach to these markets. And there are a lot of inputs to trading that need to be considered. I mean, one of the big ones that I think a lot of people sometimes struggle to think through is the idea that trading is not fun. If it's boring and you're making money, that's good. If the goal in trading is to make money, then fun or not fun is not necessarily a key input to the trading strategy. Now, I think it's fun to make money, and sometimes it can be fun to make a lot of money fast, which is why I prefer options to stock. But at the end of the day, being bored and profitable is better than being excited, and energy actually comes along with that. There's a lot of ups and downs to having fun in the market, the casino style mentality, the volatile trading strategies. But those aren't always actually the best thing for the trading account. If you can find something that is grinding out wins every day and compounding that investment, that tends to be a really good strategy relative to, up 100% one day and down 50% the next. Keep that in mind as you go through your trading strategies and your evaluations. One second here, I got to sneak. Sorry about that. But yeah, so I think overall with the markets right now, considering the ideas of how to compound that investment, things like utilities that I was discussing even again yesterday, and I've looked at a lot. That's a way to just compound an investment in a very slow, methodical, boring way. And that can be a very good thing for a portfolio. As we see interest rates falling, people are tending to go to those high dividend yield stocks like utilities, looking for ways to replace the interest that they may have made on their portfolio otherwise. So a lot of times dividend stocks become the alternative to interest-bearing products when interest rates start to fall. Okay. Successful trading does involve these steps. Portfolio allocation of 30% cash, particularly when you're dealing with options. This is key because you want to have some room to buy. And with options, of course, the risk does tend to be higher because of the leveraged elements to these contracts. All right. Portfolio drawdown is important to understand and keep in mind. If my portfolio is down more than I can tolerate, then I have to reduce for risk and portfolio management purposes, maybe before I would normally exit for a stop loss on an individual position. So having a stop loss, not just on the individual trade, but also on the portfolio level is key. When we go into our trading strategies, I don't think any of us are expecting them to be 100% correlated, but just like what we saw in the subprime crisis, sometimes those correlations go towards one, and all of a sudden everything can be a loser. When that happens, it's better to clear the board and start over rather than to try to fight the market. And that's, going back to that fight or flight response. Fighting your portfolio losses is a good way to not only not have fun in the market, but not have profit either. All right. One thing I like to do from a trading psychology perspective is to exit, reevaluate, and then enter again. It can be a little bit costly. If I have to cross markets on something like SPY or QQQ, where you have very liquid markets, then there can be a certain cleansing element of getting out of that trade, reevaluating it. And if I reevaluate and say, gosh, I actually really do want to be in the Qs still, but I now want to be long this specific strategy or this specific strike instead of the one that I had originally picked, at least I improved my trade's expected value, et cetera, and turn this into a fresh reevaluation and I really understand where this market can go for me. Okay. With the trading plan waiting for 2 to 3 days to confirm the trend change, that could be today. Looks like we're getting a bounce here this morning. CPI came in, I think, the right way. We got a little bit of a bounce back up in interest rates. I'll show you the CME Fed Watch tool. Looks like we're looking at 25 bips. That seems like it's getting more and more certain. We're up to an 85% chance when I checked it about 20 minutes ago. So it looks like that's going to probably be a 25 bip rate cut instead of 50. But having that certainty, I think, is as important as the magnitude. Okay, the market then knows what to expect next week. Long and short the market at the same time with a certain bias can work very well. We've seen how that would have worked well over the last few weeks. If I look back, if I was short tech and long utilities, I'd be looking pretty good, or long consumer staples, I'd be looking pretty good. Of course, knowing what would have worked over the last 2 weeks doesn't necessarily give me the correct answer to the test next week. But we can look at some of these setups and start looking for which setups might be more likely to set up bearish versus which setups more likely to set up bullish right now. Allowing more time, allowing more space, same kind of concept, will allow for me to stay with a trade even when it starts to go against me, and then denies that rejection or rejects that liquidation or rejects that contrary move. So, for example, if my thesis is that this market's going to go higher, but I set a stop loss that if we tick down once, I have to exit, I'm going to get stopped out at some point just from a single tick. That's too tight of a stop loss. I need to set a price parameter that's not going to happen necessarily just from random walk behavior, but more likely from a change in the money flow. Okay. So when we look at like XLU, I know that trend channel is a good trailing stop for me because it sets a parameter for when the money flow stops, not for just random walk behavior. Random walk is going to have some certain price action happen, and it can trigger a stop of when the money flow's slowing. But generally speaking, when the money flow is there, it won't allow the random walk behavior because there is a direction it's trying to go. I always say the random walk is like walking a dog. If you're trying to get your dog back to your house, you know the destination. It's just how you get there. If the dog sees a squirrel, you may deviate for a little bit. Okay? Or if the dog sees another dog or a fire hydrant, you may deviate from the path. but you have somewhere in mind to go, and you're going to continue to try to drag the dog forward or move the dog forward in whatever way you want to be distracted, but you have a goal in mind. When you have no goal in mind, you're just wandering aimlessly. If the dog sees the squirrel, maybe you guys start walking towards the squirrel, see where it takes you. That is not a stock that I can trade for a trend. That is a stock that you're just trading for random behavior, and you're looking at the implied volatility of the options relative to the realized movement. How many squirrels are out there effectively? When there's a lot of squirrels, we got a lot of movement. When there's not many squirrels, the dog may just hang out. All right. We got to wait for that volume in the VIX to reach extreme levels during a sell-off, which we really did last month, August 5th. We didn't get to nearly the extreme sell-off as we did on August 5th because it seemed like the market got some of their hedges on, and because the market remembers, even into the bounce into the middle of August, people were still more prepared. They were more hedged. They were more ready for down, wasn't as aggressive, and the move up in the VIX wasn't as crazy. People weren't over positioned to the long side. People had hedges on. There was less need to panic. And I think that's healthy for the market to remember to hedge and to not get oversized on those directional bets. Be aware of the earning dates on your position. We're wrapping that up here. I mean, we just had Oracle. We just had GameStop. If people trade GameStop, I try to avoid it because it just moves so randomly based upon when the next meme is coming. But every once in a while, I see an opportunity to try to get into it, and I'll look at it again today. I looked at it actually a couple of days ago, recognizing between the fact that it had earnings and then also the way that the skew and everything were set up, I didn't do anything. But it was sort of looking interesting on a technical basis. Had there been no earnings date and had the options market been priced a little differently, might have been finally convincing me to get in. But I tend to avoid stuff like that. Avoid the revenge trading. Avoid the haul trading. Do not call the bottom. So we look for that bottoming process, which again, I'll look at the cues here, especially as we're just getting to the open, and we can look at some of the signs of that bottoming process being achieved here. All right. And with that, why don't we just go straight into it here? I'll start with what I start with here. Well, first I'll do a quick check here. So we got everybody. Looks like everybody's on here today. Good morning to all that have said good morning. And you know what? Before we get into the other stuff, I will take a look at KView for you, Bob, because we looked at it briefly yesterday. Yeah, up over 23 again here. It looks really strong here on the market. And as long as we get back above the September 9th high, which is Monday's high, 23.23, tells me that this momentum to the upside is still there. You can see we've got kind of a forming trend line here that's fairly steep. So we had a trend here, and now we've steepened that trend. I wouldn't be surprised if it slowed down. I think we talked about that before, where it may slow down here in the 23 to 23.5 range. And that's not necessarily bearish. It's just taking a little bit of a breather on its way to the next price point higher. Where I'm worried is if it starts to actually do a rotation down, then I'd be looking for a bull flag to enter. So if we get a pullback to, say, the 10-day moving average of 22.5, then I'm looking for that higher high and higher low, kind of something like what we saw here. Lower high, lower low, lower high, lower low, and then we had the higher high and higher low showing that the 10-day moving average was going to provide support, and it took the next leg higher. So we may see a little setup like this again, but in the meanwhile, overall, there is a bull trend. It's just looking for those little nuanced new entry points for those that are not already in. And I believe we were looking at the October 23 calls before, and they're slightly in the money now. So a good way to ride the trend and have some safety in case we do get a minor pullback. These are not going to get destroyed like a 24 call could quickly go down so much in probability of return if we don't get continuation follow through. So and yes, with 6 weeks to go, the October gives some time for that possible pullback. All right. TMX. So we've been playing around with this 3.65 level. The low from August 5th looked a little nasty yesterday, broke below it and bounced back. CPI data, it came out a little lower than expected, so a little lower inflation. Looks like overall the market can handle these lower interest rates, but overall we are seeing the CME FedWatch tool, like I mentioned, showing now it was 85%, now it's 83%. So minor update here, but looking at a very high probability of just 25 bips drop instead of 50. As you know, yesterday it was 34% versus 66%. So it looks like we're going this route. The smaller lowering, no surprise there to me. But the confidence is part of, I think, what helps drive the market confidence, is seeing that the market is more confident in what the Fed will do. And then as long as the Fed does it, that's, I think, good for the market. If the Fed decides to drop by 50 bips instead of 25, when the market was expecting 25, that's actually, no matter whether that should have been good or bad for the market, I think it's technically bad for the market, because then people start to say that the Fed is a greater cause of uncertainty. That means that I have to now be prepared for volatility around a Fed announcement. We don't want a volatility around a Fed announcement. We want a certain thing. And certainty can allow people to be more confident in investing into the market. Okay. The VIX, as I mentioned, we did get a rise in the VIX with those recent sell-off, but it was not the 60, 70 kind of VIX. It got just up into the 20s. This is still above the, the highs that we had seen on other smaller pullbacks leading up to this. This one's still 23. You see here in the beginning of the pullback in the market, we were looking at 19. Back here in April, we got up to 21. So it is still a decent spike in the VIX, but it's not anything crazy. It's not the 60, 70 level. That really probably needed a new low in the market to be achieved. Last 3 days, we've had pulling down in the VIX. Seeing the VIX drop on like this on a Monday was also a very good thing, I think, for the market. So we didn't have follow through downside aggressively in the market post non-farm payrolls on Friday. So if you recall, August 5th, the drop was after non-farm payrolls. So we had non-farm payrolls on the 2nd and then mega drop on the 5th. We had non-farm payrolls on the 6th and a bounce back on Monday. Okay, so non-farm payrolls on the 6th was bad, but we bounced back on the Monday instead of getting the follow through. That started the drop in the VIX very aggressively, and I think that that's a good thing to see. When we go over to SPY here, I prefer to look at it on my live vol for those that are not as familiar with my normal charting. We see that now we are down on the day. We were pretty much unchanged pre-market, now drifting down a little bit. Hit that 50-day moving average yesterday and then pulled back. But right now we're an inside day. So we're determining what's next. We got two nice bounces here. We had an inside day followed by a higher high and a higher low. Now an inside day. Let's see how the next hour or two plays out. It requires a bit of a pullback here. Yesterday's low was 543.38. So getting down $5.50, a full percent, would be a very scary setup, because it starts to make it look like this is actually a bear flag where we do a bounce and then go, and then the next leg lower. So I'm a little nervous here if we get down another 0.5% that this could be setting up a bear flag. But for now, we're safe. Part of the signal. Overall, the bottoming process seems to be in check here. I think if I was looking right now for a long entry and potentially getting out today, would be if we got below today's low, or yesterday's low, sorry. So if we make a low relative to yesterday, if we get below 543.38, I think it's time to move on from the long. So if I'm adding or already long right now, that would be my current stop level for the day. Now tomorrow, if we just trade inside range all day, then that shifts up to today's low would be my stop tomorrow. Just using these little daily moves, daily maneuverings to determine when to get out or when to get short. Right now, I think long has a little bit better likelihood with a target around 560 in SPY. So right now we're showing some resilience in the market. We're showing that drop in the VIX still. And the VIX is slightly up now, but generally speaking, we're seeing this reduction in the VIX. We're seeing reduction in fear, and we're getting information. So as we get information, the VIX naturally has to drop. If that VIX continues to drop, we should start to see this continuing higher. Correlations also dropping, which is a good sign. Correlations tend to spike when the market is falling. You see that the high and the correlations index came in really Monday morning, but it was really off of the Friday move. And then as we started to recover, correlations start to fall and stocks start to trade more independently. That's where that long and short at the same time in this market can work really well. All right. Oh, Dow. Yes. So let's look over to Dow Jones. So we got the Dow Jones Globe. Did I do the wrong? There we go. Sorry, I added an A. Dow Jones Industrial Average. There we go. So testing the Friday low in the industrial average, that is not necessarily a good sign. That's a good point, Bob. This getting below could be a problem, but I think of Dow Jones and small caps very similarly here, where yes, they can stay negative in a bull market without pulling down the market. It's because of our dominant driving force being tech for so long. I think that these sometimes get ignored a little bit, small caps and Dow Jones and their impact on the market. Tech ultimately has to get bullish to get people really confident. Right now, yesterday's high in tech was 459.17. So we did make a new high there on the open. We are below yesterday's high. If we were to actually pull back below yesterday's low in tech, that would be incredibly negative, because then we have an outside day finishing near the lows. Very negative for this market, and I think it starts setting up for a move down to 423. So today's an important day because we had this seemingly strong start followed by already getting selling here in the first 10 minutes. So, we'll watch and see how this plays out. But right now, I don't like the way that the market opened. It seemed a lot more confident in the overnight hours. It seemed a lot more confident in the pre-market hours. And it seems like somebody out there really wants to try to push this market back down and not let it get to the highs. A good market should have enough volume, enough commitment from the buyers to get this follow through. So, for me on the long side, again, if I'm looking for a trigger to potentially enter, let's get above today's highs or yesterday's highs at the very least, to get me a little bit more confident. Overall, I don't think that long is bad here. It's just we're going through some random walk that has a slightly bearish tone to it. Okay, slightly. So let's watch those short-term charts if we're looking for an entry point today. Overall, long can be okay. Gets a lot more confident above yesterday's high and a lot more concerned below yesterday's low, which again, very far away, but we've got a long day ahead of us. All right. Good news here is that semiconductors look really strong, up 1.5%. This is a huge helper for this market because semiconductors tend to lead tech. Yeah, they got more sold off, and so they've got a lot more work to do to get bullish, but we bounced off this 200-day moving average again, really starting to show good signs that is support, and I think this could be a really bullish early signal for tech. It's our green flag instead of our red flag. So keep an eye on semis, other than Micron. Micron is my most hated, but was tested the August 5th lows before getting the bounce here. And it doesn't look too bad overall. So if this is real and we see Micron or the one that I pointed out yesterday, AMD, a little bit cleaner trade here because it did have positive earnings that then pulled back with the market pullback. AMD seems like a really good one to potentially target a move to 160 as an intermediate target, and maybe ultimately as high as this consolidation zone here around 165 or all the way up to 180, the July high. So I like the I like the looks of semiconductors, which makes me like tech, which makes me like the market. But that can change like that, as we've seen time and time again, especially over the last month and a half. MMFI 50-day MMFI looking bearish. Okay, we'll come back to that in a minute. But so we're talking about SPY and Qs. I mentioned IWM. So IWM seems to be getting pulled by a little bit by financials. So XLF yesterday, a little bit of a nasty day. Today looks really bad, going below yesterday's lows. So this is going to be somewhat impacted by interest rate moves. JP Morgan had a very bad day yesterday as they guided lower. So they pull all the way back to the 100-day moving average. We need to find some support here in JP Morgan, I think in particular, to get some support into financials, because this has been one of the bright shining stars of the financial sector. JP Morgan finds its support. JP Morgan finds a bounce back. That's going to help financials. That's going to help small caps. All right. So if I'm looking for one individual stock that I think is a potential driver for small caps right now, it really is JP Morgan's one of the first go-tos, much like I'd say I'd go to NVIDIA as a primary thing to look at for tech. NVIDIA is one of the biggest semiconductor stocks, of course, one of the big names, one of the highlights of the semiconductor industry. More important to me than AMD or Micron or Intel. It did have slight negativity on earnings, and then the pullback with the market and seeing this lead back out and move towards that previous pre-earnings level potentially gives a really much stronger feeling overall for this market. Okay, so for tech, if I had to pick one stock right now, I'm looking at NVIDIA. I'm not looking at Apple, which is okay, or Microsoft, which had been for a long time one of the big drivers of the tech market. But it's been a little bit more choppy, and NVIDIA still has a lot of influence, I think. Okay. So for small caps, I look at JP Morgan. For tech, I'm looking at NVIDIA. What else do we want to look at as like a driver for these markets? We can go into the oil names, and honestly, ExxonMobil's always the big boy to me, the first one I look at. Oil names look awful. We look at USO, it's getting a very small bounce back today. Still below every trading day's low in the last 6 months other than yesterday. So this bounce is very, very muted, very, very small. We need to see USO back in the 70, 71 range to start getting excited about any potential bullish bias in a oil company, I feel like. And you can see it's just hitting everything. OIH getting hit hard again, XLE getting hit hard again. So it just seems like it wants to keep weak. And what can change my tune would be if USO started showing some relative strength. While the individual oil companies haven't been very correlated to USO recently, this magnitude of weakness in USO does not give a lot of people that confidence to jump over and say, I better go buy some ExxonMobil as gas prices get cheaper. It doesn't give you that confidence to justify investing on it in something that really needs that increased margin to generate profits. Okay? So overall, not particularly interested in the energy sector, so I don't want to spend much time on it. I'll spend a little bit more time, though, back in the precious metals. So gold, I always start with, even though it's less exciting to me than silver. But gold, I'm starting to see a nice little wedge or an ascending triangle type look here, using the previous high from August 20th, and then this ascending trend line here. We're going to come to an inflection point shortly here if we continue to rise here slowly on the lows. So the lows are continuing to get higher. Ultimately, we got to play around with this August 20th level and see if we can burst through. And if it does, that could create a nice spike type action like we've seen in the past when we get through key inflection points. Getting above the May high pushed us from 226 to 229.5 pretty quick. All right, so you can get 1.5%, 2%. It's nothing near the crazy kind of moves in gold that we'd seen back, say, in 2009 out of a real recession, and then all of the quantitative easing process going on. But we could see a nice little spike here up to 235 or higher in short order. And I think that could be an exciting setup. Where we can get a little bit more leverage to it, I think, is in silver. This has some industrial uses, so it does get pulled back. When we see oil weak, silver tends to be weak relative to gold. When copper is weak, silver tends to be weak relative to gold. It's all correlations and stuff. But silver looks nice here, trading much farther distance from the highs. I think it's got a lot more natural upside just in the catch-up trade. So I mentioned yesterday, I think, or maybe it was Friday, that for me right now, looking at this, going into October, and buying like a 27 call gives me some leverage right now. And as we get a little bit higher, rotating into a call spread. 7.5, 27 1/4, 27.5 range is a natural intermediate target. There would still be some leverage to the upside, but if I wanted to make sure I had that leverage for the first move without capping my upside, I go with an outright call right now, noting that implied volatility is near the lows and it tends to rise as the stock price rises. So getting into like a 27 call now, and then as we get towards 27 1/4, 27.5, selling out a 29 call or a 30 call against it can be a very high leverage trade, effectively working to leg into a call spread, but understanding the fact that I don't need a call spread now because implied volatility is low. I would prefer a call spread if implied volatility rises. Okay. And yeah, I mean, a hurricane should normally rally oil temporarily, but maybe it doesn't. Maybe it doesn't matter. Yeah, and then the next one, of course. Well, first I'll do China, and then I'll come back to Bitcoin. It's starting to get a little bounce back. It looks nice today. That's good. This is showing signs of that short-term bottoming process. Got a higher high and a higher low. Seem to have found a low here. If this continues, this should also help silver, the silver trade as well. Okay. So for now, I still prefer silver. And again, as I said, looking at the October 27 calls and rotating into like a 27-30 call spread is kind of my way of thinking that this could play out for a trade plan. And if we start seeing precious metals falling and gold break below that, the low part of the trend line, silver breaking back below 25.5, then maybe this trade's over and I have to reset. Sell it out and reevaluate. And once I've reevaluated, I can get back in. This is a very liquid market. No point holding it though when it's not. That's a bad thing. I want boring and making money. And right now, it's been boring and losing money, but there is a setup here that I see that could be boring and profitable. And so I'd like to try to take advantage of that here with some 27 calls in October. Bitcoin. No bueno. Started looking like a good pull turnaround here. Higher high and higher low, higher high and higher low, and then back down. So for now, this is looking more like a bear flag. Then I keep an eye on this. If this doesn't start to recover, then those Bitcoin plays just die on the vine. They were underperforming the price of Bitcoin. So there was a lot of leverage for them on the recovery if Bitcoin recovers. Right now, Bitcoin doesn't have a clear recovery path anymore. Yesterday, it was looking really potentially strong. Today, a little more muddy. In the next 48 hours, we start to see recovery back up above the 10 and even the 20-day moving average. Again, that's 10%, or sorry, not 10%, 6% higher than now, 5-6%. That's going to give me more confidence in those Marathon and Riot and Coinbase type plays. I still think there's something there, but I already have two of them on, so I'm not going to add a third on a day that's making the picture more muddy and more bearish. Okay? So if I'm more bearish today or less bullish, I'm not going to add into it. If I am a buy the dip kind of guy and I didn't have anything on, I might consider buying into Riot today. But being that I already have it and I don't normally like to just buy the dip, I think that today is a good day to just hold with what I've got. All right, and as a reminder, I've got the 9 calls for October in Riot. I've got the 18 better than Riot so far. Riot's the catch-up that's got some real leverage if it starts to turn more aggressively. But more than likely, I'm really going to need that full 10 to 11% rally in Bitcoin, which, as we all know, can happen in like a day very easily. I mean, heck, the drop from 50 to 40 in a day on August 5th, we could easily see it go the opposite way. Going from 51 to 56 in a day, that's 10% right there in the middle of July. So not saying it's going to happen, but stuff to watch here with Bitcoin. If something comes out that gets Bitcoin bullish, we can quickly change the tune in Marathon and Riot. And the difficulty with those trades is that when Bitcoin gaps up, those stocks gap up, and then it becomes a chase trade. And you just want to have already been on the wave. And if you weren't in the wave, it gets a little bit hard to trade into it. So having a little bit of exposure, I think, is not a bad thing, but not overloading, because this is a more exciting trade. Like I mentioned before, exciting is not always profitable, but it can be fun, especially when it works out. And it can be very frustrating when it doesn't. It's generally better to buy actual Bitcoin, but unfortunately, some people just don't have access to Bitcoin, or have, it's like trading USO instead of trading crude oil futures. It's just a very nice, accessible ETF for it. But, you got like the two that I normally watch are VITO and GBTC, and even those two have very different technical looks. VITO, you can just see it as you click back and forth between these. They have very different shapes to them. This has a much cleaner downside chart. GBTC had a little bit more consolidation before downside. And then you go to BTC, Yep. How do I have to do it for this? I'm going to do it. Nope, I got to do it with a BTC USD. There we go. We do the actual cash Bitcoin versus the US dollar, $56,000 right now. And you can see that this looks a little bit different from GBTC as well. So overall, this is not a great chart. Ultimately, the September 6th low is going to be the problem point for Bitcoin. It's a very choppy nothing chart. And I think on the upside, if you're looking at the Bitcoin Cash, which is probably the better way to look at this instead of GBTC, I just try to use GBTC as a quick reference point. But above 62.5 is really kind of that level, getting it back above all these moving averages and starting to show a real trend. We don't have a trend right now in Bitcoin. We tried to create a trend here and it failed. Need to see that recovery push through these levels and start to create a trend to really get people excited. And Bitcoin is kind of like a giffen good in that as the prices go higher, demand tends to go up. As prices go higher in Bitcoin, that's what gets the excitement going. It's like a meme stock, in many ways as well. We all know how these things play out. When they're good, everybody loves it and everybody gets excited and everybody buys. And when they're bad, everybody just kind of sits and listens and says, gosh, if we can load the spring and start to make a move, great. But if not, it becomes a little bit of a why would I bother trade. Let's see. Yeah, so the other one that I mentioned before, XLU, is the boring trade. Okay, so utilities are a very boring grind higher trade. And guess what? We are touching. I need to add a day to my chart. Let's see if I can do it without. Nope, I can't. Annoying. Do that. Add a day. There we go. Added a day. So I added a day to my trend channel here. You can see using the previous lows, we've touched once, twice, 3 times, 4 times, touching again today, or very close to the lows of the trend channel. And as we play around with the lows of the trend channel, this gets a very nice defined risk potential entry in utilities. So for me, this is a good entry point for utilities. Using XLU. Yesterday I walked through a bunch of the individual names in utilities, the highest allocations in utilities, and you'll see that the charts are now nowhere near as clean as XLU. A clear trend channel in XLU, but Nextera Energy is like 15% of XLU, and it's got a bit of a trend here, but it had a lot of consolidation as well. It's a little less clear, although it's more bullish today than the ETF, but Duke Energy, bullish, but has more chop, had a longer period of consolidation. So it's got sideways and then kind of catch up and then sideways and then catch up. For some reason, XLU just continues its charge higher, and it seems to be rotating one stock at a time as it does it. Southern Company, another big one. And you can see same sort of idea. You get this consolidation, even looking almost bearish here by August 29th. And then bounce back up for another period of consolidation. So we're getting a lot of utilities consolidating in the midst of this bull run for XLU, the ETF. For me, that tells me I prefer going into XLU. That's the more boring trade. Trying to call the catch up can work if you're really good at identifying which one's going to catch up next. But if Duke Energy is going to consolidate for 3 weeks and then spike one day, if I try to call for a catch up tomorrow and it turns out it's in 2 weeks, I may have just wasted all that mental energy on something that's going sideways only to see it gap up, which means I couldn't buy it at that point, and me miss the move on that perspective as well. Okay, so I don't get the trade unless I don't get into the trade. I tend to miss that trade. It's easier to just ride XLU and take the couple bucks a month. I mean, from August 5th, the lower part of the trend channel was 71.40 till September 5th. The lower part of the trend line was 75.40. All right. So from 71.40 to 75.40, we're talking about $4 a month of just appreciation from the money flow. So if I want to make a trade out to the October 11th term in XLU, I can look and say that I could get $4 from current prices since I'm at the bottom of the trend channel. go to call it 80 and a quarter, I'll round down. There's a lot of leverage to that upside in XLU. There's a lot of upside, a lot of leverage there. If I'm getting $4 a month, I can make some decent money here, right? 76.5 calls could appreciate by $2.5 if I'm buying at the bottom of the trend channel. Now, if I'm buying at the top of the trend channel, the whole point is, if I'm buying at the top of the trend channel, you can see that that's closer to, well, whatever. It's a little bit above the previous highs. I hate bar charts sometimes, but it'd be around buying around 78. So I'm giving up half of that move. By buying here, this is a spot where I can buy the dip because the trend channel has not been negated. And I can buy near the lows and have the full breadth of the move. And if we go to the high end of the trend channel instead of the low, I'm in really good shape. And if this trend dies on the vine in a week, my stop is really close. If I'm buying it at 78, my stop is down here at 76. I got $2 of risk. Right now, I've got about 30 cents of risk. So I think this is a really interesting time to look for an XLU allocation. Now, buyer beware. We're still seeing more pullback. You want to see only 15 minutes ago, right? I said if we get below yesterday's low, that's a really bad sign. Yeah, 546.5 didn't look too likely. Now at 543.88, we're 50 cents away. So we're starting to get some very bearish signals that could stop me from even getting into XLU, because if we hit the liquidation button on the market and we sell everything, XLU will potentially get a little bit of a blip. Might be a buying opportunity, might just be the beginning of a selling opportunity. I won't know for sure. But if it can hold the trend channel throughout the day, I can look at XLU probably now that we're getting close to the stop out and the short signal in SPY. I either need to see us back towards this 547 range, bounce off these lows and not breach them, or I want to see how this handles into the close. Because right now I'm a little hesitant to buy anything when we're this close to the stopping level for SPY. So time is on my side, though. I don't have to buy right now unless I'm done for the day and got to go, do something else and be away from the screens all day. But that's the joy of trading for all of us. We don't have to do anything at any point. We choose to do it. That's another big part of trading psychology. I don't have to trade the market at all today. I can trade tomorrow if I don't see anything clear today. I do think that today is a very big day for the market. I do think today is a very potentially high value buying day, but that can quickly change tune if we get below yesterday's low. For me, probably in the next hour, I'll look to make some small buys just to start getting into the market. And then look maybe for more if we start to accelerate higher. If we fade, those become day trades where I just take the quick loss and move on. So for me right now, XLU is one way to potentially get into it. And frankly, I think NVIDIA could be a way to get into this market because it's still showing that relative bullish sign. And NVIDIA staying above yesterday's highs and seeing implied volatility down here. I could look at a call spread for a target of like 125 even and not be too bad off as long as I get enough time to it. The October $1 or the 115, 125 call spread for $3. These are good, reasonable leverage plays that just trade off of a continuation recovery in the market. And like I said, if that recovery is negated by a move down of another 75 cents, we may have problems. But for now, I'm getting close to the stop, so I'm getting the best entry price, one of the best entry prices I can get if we turn around from here. I always feel good about buying here because we're not below the lows. I didn't really call the bottom. I just said I'm defining my risk with my stop. And so I'm getting a better entry than I would at 547. Now I'm confident at 547, so I want to add, but I got a good entry here, and that helps my trading psychology because now my confidence is built off of the fact that I got in at the right level. And if we go lower, I can go back to my trading psychology and say I'm doing the right thing by exiting and taking my loss instead of trying to force a trade that's not there anymore. Okay? XLP, let's double check that one as well, because yes, that was the other one that had been trending higher. Staples look bad today. Yeah, that's one that is no longer showing that sign of bullishness. The three that I kind of looked at yesterday as potentially ooh, maybe we've got something good is financials. That was already showing some negative signs over the last week. Then consumer staples, that was showing pretty positive signs until today. And then XLU is the easiest one. And that's the boring bull trade. So this is boring bull. This is a little bit more exciting bull, but showing some good positive leadership in a sector that's big enough that it can be counted on, I think, to provide that leadership when it's right. So if I see NVIDIA continuing firmer, like I said, I think I'll look at an NVIDIA call spread as my before 11 a.m. Eastern. So within the next hour, just looking for a potential entry there. Okay. eBay was one that I know we've all been looking at. It looks very good today. I like it as it stays here near the highs. So this is just, to me, again, this is the long-term bullish play, though. We get these consolidation periods for a few weeks, and I think something like the January 57.5 calls, just an in-the-money stock replacement, way to get leverage. I can get myself exposure to to 100 shares, so $6,000 worth, but for only $580. So I can get my 100 shares of exposure plus or minus. I mean, delta based, I'm actually getting 67 shares of exposure with prices here. But as the stock goes down, my exposure drops naturally because of gamma. As the stock goes up, the delta goes higher and my exposure goes higher. But ultimately, I control 100 shares of stock from a price of 63-ish, 63, 40, 63.30, depending on my entry price. And if we get that leverage move to the upside, long-term trend stays in place, I'm going to make decent money by only investing $580 instead of $6,000. Okay. So for me, eBay looks like a good longer term entry. And I may add that. I'll probably look to add that for a trending portfolio later in the day, based upon that philosophy that if SPY collapses, I don't want to enter a trending trade that's supposed to have some longer term benefits to it out to January, based upon this entry point until I know it's going to hold. So January options, I've got a little more time since they've got less gamma, a little less leverage since they've got more time. All right. Some of the names in XLP to watch, by the way, we can look back at Walmart was spiking yesterday. That's just consolidating today, so that's still okay as well. Coke has been one that's been on a bit of a tear, but looks questionable today. So I had the fade looking like a bull flag, and then today saying maybe this is actually I don't like to necessarily call it a bear flag when it's coming off the highs, because usually you're looking for that out of a bearish setup that just had a break lower. But Coke does not look good. Costco today looking very blasé. I know that Vlad had looked at this as a good long. I think with the earnings coming up, it's just about timing the exit now. So on a price basis, getting back below the 20-day moving average, back in the 880 range would be a concern. But ultimately, if the market's firm and XLP is firm, I think Costco could push to 920 before earnings. So it still has a decent risk reward here of anywhere between $10 and $30 to the upside with $9 downside risk. The biggest thing is I got a clock on me because I would want to be out before earnings personally. That's based on my trading style. McDonald's, another XLP, and that one is weak today as well. So back into the trading range, kind of a nothing chart. Philip Morris, let's go tobacco. That's starting to break finally. So Philip Morris has been a very nice trend higher. So I'll pull it back up over here with the trend channel in place. So you can see how this is ultimately. I'm not going to bother doing the redraw quite yet, but you can see that that is breaking below the lower part of the range today. If I were to, I can't extend it. Yay me. There we go. Extend it one day without actually having that problem. So you can see that it's breaking below the trend channel here and showing Philip Morris may be done with its trend for now. So if I'm long Philip Morris, I'm looking at the exit. And if I'm looking for an entry point, it's getting back into the trend channel. So I really need to see prices back up about another $1. And then I could be entering into Philip Morris on the bull side. For now, breaking the trend channel doesn't necessarily mean bearish. It just means neutral or possibly bearish. But I think neutral right now in Philip Morris could be could be what the doctor ordered. Maybe we don't need to buy into tobacco too aggressively right now. All right. So, there's a whole lot of stuff going on there. And I think at the end of the day, the biggest things for me are seeing that semiconductor firmness gives me a little bit more confidence for the NVIDIA trade and for the tech support levels overall. I think that there's showing signs of support being there in the market, but we got some red flags out there. We've got the behavior in the financials is not showing great anything. Bitcoin is showing some risk off behavior, even though we're seeing risk on with semiconductors. So it's a little bit of mixed signals. But as long as I define the risk on the bullish side via a macro concern level in the S&P chart here that's getting within pennies now, looks like the market wants to try testing out that level below. Looks like we're going to try it. So this is why I guess I'm not in yet. Yesterday's low, 543.38, and we just did it. We just broke through it. So now I'll pause on the buys until we see how the market handles this level below. If it gets a push through, intermediate target here down towards 540, another $3. That should, I wouldn't be surprised to see that today. If that can't hold, everybody's going to start talking about the previous August 5th low, especially in tech. So I think we're in a holding period right now for the market at inflection point. I think we could go either way. I don't expect us to stay right here. What that really means is if I'm looking purely on the trade, the most likely trade to me is not necessarily bullish or bearish. If I needed to put on a trade today, it's a straddle. $7 for the at the money straddle means that I'm betting on either 551 or 537. Call it a little bit below. So, and I think that if we continue to break, naturally we start targeting these 530 kind of moves. And if we find support, we're looking for 555 and higher. So the straddle is already is pricing in quite a bit of movement here. But that's generally the style of the trade here, is looking at saying we don't have to go up, we don't have to go down, but it's unlikely that we sit at 543.5. And if this straddle seems too juicy to you, it seems reasonably fairly priced to me overall, but I see a lower likelihood of just sitting at the strike rather than moving. So I don't mind the idea of using it as a trading vehicle, but it's literally a day trade. Buying it now and selling it on the close, expecting to get some profit. And if we don't move, just getting rid of it before the theta starts to kill me. So it's not a bad trade. It's just it's not going to be a home run, I don't expect, unless we get a real pullback. The only way that becomes a home run is if the market just completely craps out and collapses here. All right. Any other stocks that people are looking at right now, please let me know. I will note, since I got a short break here in my thought process on the markets, I'm doing a webinar today. So if you go to optionhotline.com and go to webinars, I'm going to talk about preparing your options portfolio for the election. It's free, so feel free to check that out. Just a free webinar this afternoon. If you can't attend live, you can always still register and get a free giveaway, and then but you also get a recording of the replay. The only way to watch the recording is to register. So I'll email you tomorrow with the replay if you register for that. If you want to see through some of the other, educational stuff that I think through and how I'm thinking about the election relative to, what we saw 4 years ago or 8 years ago, should be a good time. And you can always ask just something else to do this afternoon if you're bored. But yeah, other than that, guys, I don't know if you have any other stocks or anything you want to look at right now. We'll look over at my sector scanner here to see what's the driving. Okay, so my biggest up sector today, interestingly enough, is solar. So we got 5% higher in solar, 2% higher for clean energy. Does that get us back into anything with Tesla? No. So Tesla's one of the big ones in ICLN, but it's being ignored in this. So must be, First Solar up 8.5%. I've not checked the news on solar. I imagine maybe it's something to do with the election conversation as well. But I'll look into that here in a few and see if there's a trade there. But that means Sunrun probably looks pretty good today. Yeah, so remember this one we were looking at before as a potential for that breakout to the upside. It's been a nasty run here. This could be getting an interesting setup for a move back to 22. So there's leverage there. Normal daily move is about 4.5%. So we're already 2 standard deviations today, but it could be setting up a run that justifies a call spread here, like a 1924 call spread or a 1923 call spread. $1.20-ish for the 1923 call spread's not bad. So $4 wide, 30% of the max value. I don't hate that, targeting a move just above the previous highs. So the previous highs were 22. So I like selling my out of money call on a call spread just above the previous highs. If we get a full move through, I actually make a little bit more money, so I get a little bit more leverage. So I like to do my short just above, because you want to go to, not through your short strike. And in this case, that would be just barely to, maybe not quite all the way to it. And there we go. And now we are looking nasty there with that last couple minutes here. As I'm talking about sun run, we get in the last minute, we hit some stops here, drop from 543.39 in the spiders. So looking bearish now. Trades I was looking at as potential. Trade desk, it delayed the move because it's not really all that bearish, but when it hits the liquidation point, which I think would be potentially below the 9.9 low, this could drop quickly down towards 90. So, you know, this could be one way to trade for the bear move. Or I could just simply go back to some of the other semiconductors and say that the bounce back today is not going to get any follow through. Intel's already so deep in the gutter, but, you know, AMD does have some leverage if it gets to the downside. Micron, if it breaks the lows, it could get some real downside here. And then, of course, NVIDIA that I was just talking about buying, maybe ultimately that's the trade is to say sell some NVIDIA, even though the market has cleaned up its long positioning in NVIDIA. The downside seems to be there with the S&Ps dropping the way that they are right now. So we'll have to see how this handles the next hour or two. If this can't get a fairly reasonable bounce back to start looking more like what happened on August 5th, where we kind of had a washout move and then a bounce. I mean, ultimately, I actually think that for both the bull and the bear, we kind of want the answer. Let's get below the September 6th low, 539.44, and find out if that is going to be reasonable to keep pushing below it, or if that's going to be the spot where people put their foot down and say, I'm buying this market. So sometimes just getting the answer, yes or no, is better than maybe. And right now we're in maybe territory on this the September 6th low. So I'd love to see us get below the September 6th low. Like I said, then maybe we can get some clarity on whether this is a real downside market. Tech is showing a little bit of relative strength here, staying above yesterday's low, but somebody's getting super aggressive here. Or maybe we get a little news blurb out. They can turn this market around quickly, but right now it seems like sellers have control. Yeah. Oh, the website, Carol, was it's so optionhotline.com is for my webinar. So it's optionhotline.com webinars, and you just sign up right here for the election webinar as that'll be this afternoon. So hope to see you guys there. And like I said, if you can't attend, you can always get the free replay if you sign up. So yeah, so I hope to see you guys there, and I hope you bring some interesting questions. And if you don't worry about it. You can always email me questions as well. And my email is keith@optionhotline.com, but I'll also put it up there during the webinar as well. And if you guys have questions from this stuff, you can always email me again. It's keith@optionhotline.com. I'll just type it into the, yeah, you can see there. Yes, I have 7 emails in my inbox right now only. I try to keep it clean, but keith@optionhotline.com. If you have questions, feel free to email me and we can chat. Okay. All right. Well, unless anybody else has any other questions, I think we're just going to be watching to see if this meltdown turns into major liquidation today. So, you know, be on your toes. If I was exceedingly long right now, I'd be very nervous. But right now, instead, I'm kind of excited because I want to see what happens, get some clarity off the September 6th low, and maybe we get that answer today. Maybe we get that washout trade. Maybe we get that VIX spike. Maybe we get that volume spike that we haven't really gotten yet in this part of the liquidation, and then we can start to heal from really the August 5th break as well as this follow through in September. So we'll see how it goes. But everybody have a great trading day, and I'll be back tomorrow for the close. But I'm sure. I don't know if Vlad's going to be on the close today or Scott, but I hope that the trading day treats you all well, and make sure you just follow your systems and trade within your own strategy. Going outside the box is good for thinking purposes, but until you really understand the strategy, it's hard to put that money there and just taking bets. If I'm a poker player, I don't need to go to the craps table. You can wait for the poker table to look good. All right. Thanks again, folks. We'll see you tomorrow. And I'll see some of you this afternoon on the webinar.